the way it really works is you take money and credit away from people, right? And something else costs them, so they spend less. And because they spend less, then you have less inflation.
Yeah.
All of them have been painful, and we produced a whole lot of debt. And so now even the Federal Reserve is going to start selling 1.1 trillion. And then you have the Treasury selling $1 trillion. And so there's a lot of selling, and what that does is it takes private credit. You know, the way the system works really is when you get a little bit of, you get weakness, you get a shot of credit, and it's like a shot of an upper. And so that gives you buying power. And it shouldn't be surprising that when you buy a lot more, that
right.
inflation goes up. I expected it to go up about where it is.
Right.
But then we also had other things. You know, we had the Ukraine, and we had something. There's nothing precise, but I expected it, to go up quite a lot. Because inflation is due to the total amount of money spent divided by the quantity of goods sold. Nothing more than that. So when there's the giving buying power and you spend a lot, you know, we've increased the money supply, and by any of the measures, enormous amounts. So, yeah.
Can we get a soft landing doing what we're doing right now? Markets kind of hope against all odds that we can, and we avoid a recession. What do you think?
You can't keep spending without and bring down inflation. So here's what I think. I think that we're not going to be able to bring an interest rate to a high enough level to give a good real return to holders of credit without causing a contraction in economic activity.
Worse than what we're experiencing.
Right. You had an 8% inflation rate. Look at what people get, and we're talking now about a 3% interest rate, and people think that that's good.
Right.
So you're going to lose money, lose buying power. I think the inflation will come down a bit, but it's going to be very high, and money's going to get a lot tighter. So you're going to have a stagflation, right?
Like we had in the 70s, worse? What do you think?
These things, similar to the 70s, but none of them are all the same. There's always a paradigm shift. The way a paradigm shift is, it's like if there's a 10-year period, and almost every 10-year period is the opposite of the 10 years before. The 70s produced the 80s.
Yeah, I was amazed to see that. It bears out, doesn't it? Yeah.
And well, the reason is, at the end of a period of time, everybody believes that the future will be like the last 10 years.
Right.
And everybody's positioned that way. So when you look at the environment that we had over the last 10 years, not inflation, no low interest rates, availability of credit. So these moves take place typically over a period of 10 years, and there, let's say, two legs to the move. So you have a change in mindset. People thinking what is safe. Used to think that cash was safe, a safe investment. But cash it loses buying power to inflation. So now, as people realize that loses buying power, and as the Fed has to deal with the tightening of monetary policy, you get the first leg. And that's the first leg that we're in. And when that runs its course, which it probably would run its course, I would say, in the next 18 months or so. There's nothing precise, and I'm not sure that I'm right in this, right? I'm just saying, I'm giving you what I think.
Right.
That if you take the cycle, you have to raise interest rates high enough that it produces an adequate return. Otherwise, the sellers, they're going to sell their instruments. And that if we look at the supply demand for credit, the Federal Reserve is going to sell 1.1 trillion. You have the government sell trillion, and you have others selling because it doesn't provide a good return. That creates a certain tightness of money. That creates a fall in the contraction. You have a contraction in spending power, credit. And so that's what's likely ahead. So you have the first leg of the move. These things take place until the opposite is true, until people believe that cash, it won't be a good investment until there's the inflation. So I think that you have the leg, like 1971 into 72 and then 3, tightness of money policy causes 1974-5, bad recession, bear market, easing of monetary policy, then you get another leg up, 76, 77. Then you have the higher level of inflation, then you have the tight money policy. And at that point, everybody believes that I never want to own a bond. I only want inflation hedge assets, because that's how they're positioned. And then the opposite happens in the 80s.